start with Old Mutual. Remember, this one's got a lot of stuff going on. Yes, it's Cape Town based and it's a global player in terms of life savings, investments and so on. But remember, it made a major foray into the US and UK and other global markets back in around 1990 and thereabouts, and it's currently contemplating a major reorganisation with new CEO Bruce Hemphill, an ex-Standard Bank man, basically saying he's going to crack and break the group up and split it into 4 pieces, although it remains to be seen how that's going to be pulled off. Market capitalisation is 188.98 billion rands. Price earnings ratio 13.42 based on the recent numbers. Dividend yield high at 5.18%. So how do you think Bruce is going to do it, and which pieces are we going to get, and how is the process going to unfold?
So I think the first thing is he's incentivized to do it as quickly as possible.
Yeah,
and some people in the media
Yeah.
wrote a few pieces about that. But I don't see it anything wrong if you pay him a few million pounds, but actually the value unlock is a few hundred million pounds at the end of the day. It incentivizes him to do it as quickly as possible. How it will be done? Well, it will be the US asset management business, which is already listed. They just need to sell off their investment.
It's already 20%, I think, free float, and they could just distribute the rest to the shareholders or something, or sell it to someone.
Correct. The second part, which is already listed also, is Nedbank, which could be relatively easy to dispose of.
You say easy to sell it to someone or unbundle it to UK shareholders with local register shares?
So to take a step back, they probably first need to split the SA business with the UK business so that you have SA shareholders and offshore shareholders, and then you unbundle Nedbank only to local shareholders who would want the Nedbank shares. Because I agree with you, a lot of offshore investors would say, I invested in Life Assurer and now you're giving me shares in the SA bank. What's this, and don't want the shares.
Okay, so that makes sense. Separate them first. Okay.
And then the third piece would be the local Old Mutual life assurance business, a big, long-standing, very profitable business, good operations in the lower end of the market, in the Mass Foundation cluster business, and the top end of the market with their more
and a growing
affluent
African presence outside of South Africa too, because of recent additions and acquisitions.
Correct, and partnering there with EcoBank and really building out with a lot of capital behind it into the rest of Africa. And the last bit is the wealth management business, which is the UK business. Correct. A platform business, if you want to call it that, which means that people invest on a linked investment scheme platform. They make fees off the platform, as well as try to channel that money into their own funds and make asset management profits as well.
And that's a business that a lot of UK asset manager and wealth managers would presumably be interested in buying as a bolt-on to their own operations.
Yes, it might be big, but the likes of St. James Place, for instance, and a few others are competitors to this business and probably would like to own it. And the tricky thing here, if you add all the pieces together, you get a lot more than the value of the current mutual share price. But what are the central costs, whether it's IT costs in the Old Mutual wealth management business or head office costs? Maybe there's some leases left on the head office in London. So there are a few uncertainties regarding the negative number you need to subtract when you add the sum of the parts together.
I see. And that's, of course, where potentially, you know, it depends also on market circumstances, because the value that they'll receive for these different pieces could rise as a result of, you know, favorable reception. So the question is it attractive to investors to buy now?
I think at the right price it is, and I think the right price is relatively this price.
Well, let's look at the chart, because that'll put it in perspective. Done well, it's sitting at around 40 something. Or thereabouts, 38 or something. Where is that share price? And
just under 40. And I think below 38, you've got some margin of safety in the breakup and the uncertainty of the negative number of central costs. Below 38, the further below it, the better in terms of getting in at a good price. And once it pushes up above 40, you're already paying for some of the benefits, I think.
So just one final question. To what extent is the potential for sort of economic trouble here, sovereign debt downgrade, is that going to be a real issue for Mutual? Do you think it would have an impact on the share price?
Yes, it could. Because of the Old Mutual wealth management business, which has operations in the UK, the first thing is the movement of the pound. So if the pound strengthens a lot, if Brexit should happen, that's actually quite good for the business, but it could also be seen as being bad because it might affect the inflows to that business. And if the UK
Brexit,
business,
and there's also the South African uncertainty potentially.
Exactly, we have a credit downgrade locally. So you've got these two jurisdictions with these weird.
Because realistically, what kind of time frame are we talking about here with the Hemphill program? Is it going to be a year, or is it going to be 6 months? 2 years?
I think somewhere between 1 and 3 years, and that's quite a big window, but it depends on exactly all the regulatory boxes that need to be ticked.
Okay, so you're liking it, but you're saying be careful about your entry price. Current entry price, you're happy? You're saying it's hot?
I say it's hot at this current price and lower.
Okay, good. Let's go with that. Hot too.